Good evening and welcome to our presentation, How to Invest in a Fear-Driven Coronavirus Market, and most importantly, when to act. There's still people coming into the room, so I said if you could just say hello to me so I know things are good. And if you wish to ask a question during this presentation, that's not a comment, I'm very happy to answer that question. And so just type it into the question panel. That should be on the GoToMeeting panel somewhere in front of you. So let's just get started and discuss who is this presentation for. This presentation is for investors who want to think in a logical and objective way, making clear decisions and not be driven by fear. I have done this presentation now for 3 weeks, probably about 6 or 8 times. So it is generally a repeat of what I've already done, but I've added bits and pieces into it as I've progressed each week. And this week I've got a little bit of economics information. So who am I? My name is Paul Wise. I'm the founder of Momentum Investing, providing educational advisory to high net worth individuals, both retail and institutional. I do Options 21, which is a slightly different group which focuses on specifically on options markets. I started my career as a registered representative of the Sydney Futures Exchange. I'm a responsible manager for an Australian financial services license, the numbers on screen. And the content that I'm talking about this evening is, I just want to stress, it is an area of knowledge which I am very knowledgeable about. I won't go into recent accreditations, but I am certified as a market technician, or about to be, by the Market Technicians Association in New York. This area of portfolio management, technical and quantitative analysis is exactly what I do. Some people have been asking me what do I or how am I performing in this market. This is dated because I took this a week ago or a week and a half ago, but my cumulative calendar year performance is 15%. So the question needs to be asked, why is it like, why can I get 15% in a market that's falling 30%? The answer is what I did in the context of the markets as they started to fall. And what I did in the context of markets was exit the market with stops at the top, then shift all holdings within my portfolio to US dollars with a declining Australian dollar and a US dollar holdings. That is of immense benefit to my presentation, to my account. My view is that that is a solution that was available to people holding portfolios in Australia and may not be suitable if you're listening to this overseas. Since that fall down to about 59 cents, the market has recovered up to around 60 cents, but I am of the view that it will continue to fall as the market starts to once again capitulate, which I would point out that the Australian dollar, I'm standing on the west coast of Australia, the Australian dollar is highly correlated with the Australian equities market, and I am of the view that there's more to the downside, which is a part of what I'm going to present to you this evening. So we are in a very uncertain time, and most people are very uncomfortable with uncertainty. I'm not, because I don't use emotion, I use logic and objective assessment. If you are in a state of high anxiety, you're probably having a great deal of difficulty making investment decisions in an uncertain environment, but this is something which I describe to you as a fear-based corrective phase. It's got no basis in geopolitical or economic. It's not an economic fall, so therefore regardless of its drive, I suppose, I've been here before. I've been in many fear-based corrective phases within financial markets, and this one is absolutely no different. I just want to point out, as we progress through this global crisis, many people source information from the wrong source. If it's medical, just go for medical professionals. If it's financial, you should be going for financial professionals that are qualified and have a track record of building portfolios and analysing markets in really uncertain environments. Why? Because if you're going to listen to people on Facebook, they're going to lead you across or over a cliff, and I am hearing some ridiculous things, and I'm going to address some of the so-called ridiculous things that I hear sometimes. Okay, so looking at this particular screenshot, I just want to make a point that in all fear-based corrective phases in the market, we have a start, a midpoint and an end. So we're obviously well beyond the start of this, but are we at the midpoint of this global drama, if I may call it that? And the answer is, of course, we're not. The midpoint from an economics perspective will be the bottom of the market. The end will be an indeterminate time well into the future, which we are nowhere near. So this evening, I just want to get a sense of how far that could be, how deep this corrective phase could be, and where the market could potentially get to as we move forward. There are some, as you're watching the news and moving forward in time, there are some positive signs in China that give us a sense of the duration of this crisis. I am going to talk about financial cycles and economic cycles. Don't relate the depth or the breadth of this global pandemic to financial or economic. It is a driver, but it's not totally correlated. The duration of this crisis, this health crisis, will dictate whether the crisis morphs into a major financial crisis. My view is that if we describe it as a financial crisis, it's going to be very, very short-lived. That's my view, and I'm going to demonstrate why this evening. And I'm going to try and get people to stop focusing on the negative and start strategizing to the positive, because there are so many opportunities, of which I'm going to give you two. I've just mentioned one. I've told you the first opportunity was to hedge your portfolio in currencies, not equities, not options, not inverse exchange traded funds. They're all very, very problematic in this environment, and I haven't got the time to explain why they can be very, very dangerous in what could be a corrective, a panic or a big capitulation. This is a pullback in the market. It is heading into a point where we may have a recessionary period within global markets, and I'm in Australia within Australia, but I believe that it will be short-lived, and I've got historical evidence to demonstrate why. What we all don't want to be at the end of this crisis is looking like this guy, all strung out, all washed out, nervous wrecks. If you are suffering from high levels of anxiety, I'm not a medical professional, it's just me talking. It's what I do. I turn my TV off on a Friday lunchtime, and I don't look at my TV until Monday morning. I don't need to see escalating negative news amplified by the media, because I want to end up like this guy that is surfing, happy, financially secure, and taking, just taking a measured approach, keeping my family safe. So in this presentation, what I would like to cover is a quick discussion of the business and financial market cycles, and just show you what the global financial markets do in response to crises within cycles. And there is historical precedent in what I'm telling you, and on all likelihood it's about to repeat itself. I want to talk about the technical context of a correction. I want to talk about the time taken for a correction to unfold. I want to mention the dog leg. I want to talk about technical price structures of corrections, the VIX and corrective phases, technical price patterns, why support lines are meaningful and why they're not. I am going to do some Fibonacci projections. Why are they important? Because they define support lines in highly emotive environments that will dictate where this market's getting to. But what actually defines the Fibonacci line as a meaningful support line is the volume behavior at these lines. I just want to stress what I'm talking about this evening is only 50% of our hedging and market correction model. Everything beyond this presentation, it's custom. It's what I get into with private clients. So if you do ask a question, I don't answer it perfectly. It's because I reserve something for my clients. First point that I'd like to make, and that is, just give me one moment, that there are two cycles within financial markets. There is a financial cycle, which was the equity markets, and then there's a business cycle, which is the economic cycle. The financial cycle and the business cycle do not track together. Just so we're clear that we are, as investors, investing in the financial cycle, and everyone is listening to the negative comments about the business cycle, which is when they talk about recessions and depressions. So if you focus in on the economic cycle and let your brain get taken away with the negative, you're going to miss out on what's about to happen within the financial cycle. And the financial cycle, that is the stock market, the equities market, is a forward discount mechanism that factors in the future. Once the market has factored in not an end to this health crisis, but a point where there is recovery in near view, as in the future is about to change, which will be the topping of probably death rates around the world, you'll see the financial markets start to strongly recover. So I'm just telling you stuff you probably know. Business cycles, that's the economic cycle, go from boom, recession, slump, recovery, boom. My sense is, due to the high levels of intervention within global financial markets, the recession that we're supposedly in, which we weren't in only 2 weeks ago, will completely reverse very, very quickly as the market finds a low. The financial cycle, that is the enthusiasm, the exhilaration, the topping of a market, the unease as we go around into the red section, the denial that it's actually happening, which was 2 weeks ago, and we are now, at this point in time, we're at the pessimism. But what we haven't done yet within global financial markets, we haven't moved into the panic or the capitulation. And I'm trying to get my brain around what global negative fundamental is going to push us into panic and capitulation, because that's when the market really has a fall. I think it's been quite orderly at this point in time. I don't want to attach it to people dying, but maybe it's the escalation of death rates in the United States where it gets out of control, or something to that effect, or it could be something that we can't see, which overlays this health crisis, and it causes people to give up hope. That's when everyone sells at the same time, everything, not that they haven't done it already, but the market then capitulates, and I'm going to do a model for that, a technical model, and it's at that point, I believe, is probably going to be the second opportunity. The first opportunity is capitulation, and I'm going to give it to you in a moment, when that should occur, and the second opportunity will be the bottom of this market. Due to the intense intervention by US Federal Reserves, Australian Federal Reserves, and all the reserves banks around Australia, plus fiscal and monetary policy by governments around the world, which is all coordinated and it's all highly correlated, you're going to find, I believe, the market do a V-shaped recovery, which will be quite a sharp-shaped recovery, with the market moving back into an expansionary phase in the not-too-distant future. Okay, why do I think this could be even possible? First of all, this is a graphic of the Fed balance sheet, and there's 3 green arrows on screen. The Fed, or increases the money supply or its balance sheet in times of panic. The first arrow on screen represents 2009, 2008. That's the bottom arrow, and the red increase in line represents the increase in money flow or money supply due to the actions of the US Federal Reserve. That has a huge impact on global financial markets, in this particular case the S&P 500, and the market starts to rally. in 2010, 2011, where the second green arrow is. That was the Greek credit default potential for Greek sovereign debt default, and the US Federal Reserve came into the markets again and increased the money supply. And the third arrow, which has only just occurred in the past 2 or 3 weeks, is again they're coming into the market, increasing the availability of cash as this market's fallen. This is a tool which didn't exist in 1929. So when someone tells me that we're heading into a 1929 crash, depression and collapse of the banking system, what they don't get is that was then, now is now, and the level of tools that banks and governments have got at their disposal and the actions that they take, which have been proven to work, whether they be right or wrong, I'm not going to argue this, which they've been right or wrong, are actually being used right now to reinflate markets as they fall. So this is not something which is weird theory. This is actually this is the purpose of having Federal Reserve banks. So what does it mean when the Federal Reserve increases its balance sheet? It means that they're expanding its balance sheet and increases the financial system supply of bank reserves, which essentially currency deposits at central banks. It does so to increase and create a steady supply of dollars to smooth over very turbulent times during economic events. That's one big deal. That's one thing, okay? Here's the second. Banks, not the US Federal Reserve, but banks put more money into the economy by borrowing from the Fed. So the Fed increases the money supply, and then the banks via repos, I'll explain what that is in a moment, increase the availability of money. We're seeing that in Australia. You see it on TV all the time. So in 2001, when we had 9/11, we had a huge increase in the repos availability, and the market bounced. In 2008, the same thing. And right now, it's occurring again, where banks are able to borrow essentially unlimited funds from the Federal Reserves and make it available to business and the general community, which reinflates equity markets. What's the purpose of a repo? You may not have even heard this term before. It's simply a repurchase agreement, and it's a form of short-term borrowing for banks in government securities. They're typically used to raise short-term capital, and they are a common tool of central banks central banks, reserve banks and banks to affect open market operations. So I'm hoping you're starting to see a picture here. This is not something that is not used in every crisis, and it's not a new thing. It's being used all the time. You may not even know it's occurring, but it is the reason why in Australia, if I ask someone, do they remember the Great Recession of 2009? And they go, no. And the reason it's a no, because we didn't have a Great Recession. Part of it was China, part of it was not necessarily Fed action, but it was monetary and fiscal policy driven by the Australian government to basically support falling equity, or the potential for falling equity markets and falling economic activity. There is a problem, though, that I am told, and that is, again, it's rooted in not ancient, but traditional economic theory, and that is, if you inject large amounts of money into an economy, it can historically drive inflation. And inflation, using a very quick definition, it's caused by money chasing the same amount of goods and services. If the demand for goods and services rise, this is pretty obvious, what happens to price? It goes up. So inflation is chasing a set amount of production, but something occurred in 2009 which changed everything, and that is that in 2009 in the US, I can only talk for the US, in the US, production increased in alignment with the injection of large funds from Federal Reserves and banks around throughout the US. So what occurred is more dollars didn't chase the same level of goods produced. More dollars chased more production output, therefore negating the inflationary impact of money injected into the economy. And what I'm finding is traditional people that may be a little bit old, or they didn't live 2009, they're picking up economics books and they're not relating to what's recently happened. They're tapping into old theory that I may have learnt in uni, but it's all old. It's changed. The world has changed. And this is probably going to happen again. So they are inflating the markets with money. The market is flooded with liquidity, and inflation is a possibility, but didn't happen in 2009, and maybe, I would suggest, won't happen again, because we've got a completely different economic system than we had back decades ago. My last point for a quick recovery. PE ratios in the S&P 500 stocks are at an amazing level, an amazing low level. I was speaking to a gentleman not so long ago. He says, I'm not going anywhere near the markets because they're all overvalued. That was true 4 weeks ago. Now they're not, because of what's happened in the last 3 to 4 weeks. So we've got markets that are valued now, price to equity ratios, back in 1988. So this is a fundamental which is going to drive value-based investors back into the market as they sense a technical low. For those people that don't know what a PE ratio is, it's a ratio for valuing a company that measures its current share price relative to its per share earnings. The PE ratio relates a company's share price to its earnings per share. A high PE could mean that a company is overvalued. Okay, so we're now in low PE. So companies are undervalued in the current market. So I'm just giving you, this is not just looking at traditional economics, non-traditional, I suppose, economics. This is looking at fundamentals, a rationale. Why would people come back into the market? I've just given it to you. So I'm now going to switch over to my to a package, a charting package. I apologise, I'm going to be a little bit clumsy, and just give me one moment because I'm going to do some technical justifications for the points that I was bringing up at the beginning of this presentation. So I'm just going to drag across and my program has just disappeared. Give me one moment. I just have to get rid of the PowerPoint presentation. Give me one moment. Okay, I'm just bringing across my charting package. And for this second part, it's not economics, which is boring you senseless, I know, but some people have accused me of too much optimism, but my optimism is built on knowledge, on precedent which has occurred within the last decade. So those people that are focused in on the negative are focused in on the wrong cycle and are focused on stuff that happened 20 years ago back in the 70s. I think you get my points. Okay. In the context of this corrective phase, I just need to first of all talk to you about the context of a correction, and that is that there are 4 little arrows at the top of the chart, and each of the arrow points to a corrective phase, whether it be a pullback or an actual correction, which is a corrective phase over greater than 10% defines a correction. Each one is driven by something. The first one to the left was driven by the US Federal Reserve trying to raise interest rates. Market rejected it. Second one, tariff discussions between China and Trump. Third one, tariff discussions, China and Trump. Fourth one, impeachment discussions. The interesting thing about this particular market, this particular fear-based corrective phase, is that on each of those 4 points, a politician or a Reserve Bank governor could come into the market, say soothing words, change policy and change the direction of the market. What I love about this one is that no person on the planet can predict or say anything that's going to change the direction or the trajectory or the timing of what's going to happen. What I do know though is that the trajectory of this market is driven by something which I know very well, and it's human fear. And that human fear, I know can be technically analysed because I've done it many, many times before. So let's do a technical discussion here. Let's do a technical breakdown of 2009 and the current market. I'm going to use this as a template, the 2019 as a template. You must remember I said this 4 weeks ago, and exactly what I said 4 weeks ago, I think I said this at least 5, 6 weeks ago, is exactly unfolding in the market today, if you wanted to go back to my original presentation. So I think this is really worth listening to, and you can make a bag of money if you listen carefully. Okay, I want to go back to 2009. No, sorry, I keep on saying 2009, I'm misspeaking. I mean last year, 2019. And I just want you to have a look at the pattern and the timing of the pattern. This is a corrective phase which took 3 months. Now the timing of a corrective phase from high to low is dictated by the speed at which negative news is unraveled or is presented to the market. My sense of this is this was a very orderly corrective phase, and the current market is very disorderly, meaning the flow of negative news, it's happening at such a pace. My sense feels that this is not going to take 3 months from high to low. It actually may be a lot less, and I'll know when something really nasty, some nasty bit of news comes out and the market does its panic stage, that's it. And if I was to put a guess on the financial cycle low, somewhere towards the end of this month, I am not predicting, and I cannot see the future, but I'm just putting a time on it, because if the market has fallen over by the end of the month, is hitting a critical Fibonacci ratio, and I'm analysing the institutional volume behaviour at that level, I can confirm quantitatively or technically that what I'm looking at is a low. Let's just have a look at this chart to start with. Okay, I might just delete. I've got a few things on this chart which I'm going to delete. Give me one moment. Too many lines on screen. I'll demonstrate what these lines represent in a moment. So looking at the 18-19 corrective phase, the first thing I'd like to point out is the market had a fall, had a rally, and then had a fall. That movement, I call it's not really a three-row structure. I just call it a dog leg. It's very crude, but the point that I'm trying to make here is that dog leg, that fall, corrective move and the fall equates to 19 days. Then the market rallied 8 days, and then it fell, rallied and capitulated. Now, in the context of the current market, where are we? If we use this as a template, we're right here. We're right on the 9 day rally. Let me show you exactly why that is so. Coming across to the current market, it looks a little bit strange because the ranges are so wide, because the fear has been so great and the sell-off has been so quick. Historically speaking, we are probably aware this is one of the fastest sell-offs, but I believe it's orderly, and the range width or length is quite high due to the market. It's at 3,000, or nearly got to 3,400, 3,500 on the S&P 500. But if we equate the current market to the 19 pattern, we've got a fall, we've got a rally, and we've got a fall. Now, down to that little arrow down the bottom equates to exactly 19 days. So, and I'm doing day counts. I haven't done day counts for decades, but I've gone back to my skill sets that I used 20, 30 years ago. So looking at day counts, that's 19 days from high to low. And I was saying a couple of weeks ago, expect the market to bounce. A few people said there's something wrong with me because the market's about to capitulate right from there. Well, it didn't. It started to rally. If I count up from here, and I don't mean to, I'm just going to have to get rid of this phone call. If I look at this particular market and I see the market start to rally from here, I've got a market, if I just do a count, market will move if I do an 8-day count from the bar where I've got the blue arrow, 1, 2, 3, 4, 5, 6, 7, 8, we're essentially at a point which maybe not now, but we're at a point where this market could start, not the beginning of the capitulation, but it's the beginning of the end of the capitulation. If the market completes what I just showed you in 2019, we'll see a fall, we'll see a rally, and that point over here is the capitulation. Now, I can't tell you right now whether this market just does a straight capitulation or whether the market puts in a fall, a retest, and then a capitulation. I can't tell you that. I don't know. But what I do know, that we are very close to that first leg down. And if we get a leg to the downside, in the context of the 2019 fall, I can do projections. There's many ways I can do projections. If I did a projection starting on the first leg to the downside, I'll just do it for 2019. One moment. If I did a projection to the downside, just using the first fall, marking it down for the capitulation phase, it hits very nicely 1.618, which coincides with one of these blue lines. These blue lines mean something. I can repeat the same process for the current market, and it does give me a level, but it's not my preferred way of calculating a support level, but I'll do it just for the exercise. Looking at this particular market, just grabbing the range to the downside, grabbing the high, grabbing the low of that range, marking it down from the theoretical capitulation point. We've got the 100% extension to the downside hitting one of these thin blue lines at 2034 and the 1.618 Fibonacci hitting 1703. So that projection to the downside fits very nicely with those two blue lines, but there's something else about those blue lines I'd like to show you. And I'll give you the significance of them in a moment. I'm going to go out to a weekly chart, and I need to contract this chart up. And I've got, first of all, a 45-degree blue line going up the screen, which represents the range or the trend of the market from 09. It touched many points on the screen as it progressed from 09 to recently. It touched the market in 2012, touched it in 2016, touched it in 2019. Now, I could have drawn the angle of this particular line just a little bit better. I can adjust it anyway. Watch that. So it's a line of best fit. As the market started to fall and touch that line, there was absolutely no indication that that line was going to act as a level of support, but that's not what I want to show you. I want to show you the blue lines. The blue lines are important because we can do other calculations in Fibonacci, which I have used many times over, to give me levels of support which become really important within this market. And the range that I would use in a much bigger context is the division of range from 2009 low and the recent high. Lo and behold, calculating the division of range, they match up exactly with the projection to the downside. That's called a convergence. That is significant. That is important, and I will pay very attention to these lines on screen. Can I tell you which of these lines represents a major support line today? Of course I can't. That would mean I can see into the future. But what I am very, very good at is analyzing support lines in real time, looking at the activity of institutions which tell me that that is actually the line that is acting as the major floor within global financial markets. And I can tell you this doesn't exist at the moment. So the market has no floor at the moment, but the 50% pullback of the range 09 to the present, or the 0.618 pullback, which is probably the most likely but not definite, they are those levels which will become very important in the next month. If we get a capitulation, that means a panic and a capitulation, they're the levels which this equity markets may get to, and then start to accumulate, and then start to do a V-shaped recovery for all the reasons I've given you so far from a technical and a fundamental, PE ratios, and an economic perspective. I can't give you any more perspectives than I've done. Just as an added piece of information, I look at the market not only from price, but also from the perspective of the VIX. And the VIX is very, very important. I'm not going to explain what the VIX is. If you don't know, you can look it up after this presentation. The VIX is extremely important because it gives me a sense of the unfolding demand for put options by institutional fund managers. When I'm looking at this particular market, or this particular chart, I showed you earlier on that thing called the dog leg. That's the first fall, the recovery, and then it moves into, you know, its corrective pattern. On screen, the dog leg is represented by the first two arrows on the screen, in the middle of the screen, October, November. This was 18 coming into 19 last year. I want you to note that the VIX, or fear within the markets, or volatility, isn't a one-day, one-week event. It unfolds over a period of days, weeks and months, and has many, many different spikes. And that is why, watching the VIX in the current market, I can tell you with a reasonably high degree of certainty that the first two arrows on the screen represent the dog leg in the current market, and there is lots more volatility to come. My connections at Cboe in the US are preempting using quantitative models that we could see a spike in the VIX as high as 125, which would be pretty crazy. In 2009 it was 100 or just under 100. Currently the VIX is at 50, 60. So there's more to come in the context of the demand for puts, which is the driver of this chart. Higher demand, higher price, higher price. The options imply a higher level of volatility, and the aggregate demand is demonstrated on a VIX chart. So I've done this and seen this so many times before. That's why it doesn't look complete to me and gives me the sense that the context or the timing, we are only just past 1 month, month and a half even, and there's more to come. Okay, just give me one moment. I've been talking endlessly and quickly, I apologise. So I've talked about the context of a correction, I've talked about the time. I have shown you what a dog leg is, or a three-way structure, and I've related that to the VIX. We've talked about technical price structures of corrections. I just did the VIX-N. I've mentioned support lines are just lines on a screen. Unless you can analyse those lines with proper skill sets, you're wasting your time. They're just a line on a screen. So don't draw lines on your screen and go, that's where the market's going to stop, because you're looking at old support and resistance. It's just meaningless. I've done Fibonacci projections in two ways, and there was what I described as a convergence on screen, and I believe I can't see any questions, so that's okay. No need to ask me any questions. Let me put back up my PowerPoint presentation. Okay, just give me one moment. I just need to, this is a clumsy side because I'm working on multiple screens in my office, and I can't just stick it all on one screen because it doesn't work. Okay, I'm nearly there. Okay, let me just open up this particular screen again and come back to the guy with his eye hanging out, which is what we don't want to be at the end of this at the end of this global health crisis. You'll get there. You'll be like this guy. If you, as I said, if you're watching the news and focusing on all the negatives, and you have high levels of anxiety, if you can control your levels of anxiety, it's really easy to do. Just refocus on the positive, reframe your thinking and look for opportunity. And I'm talking in the context of investing in financial markets. Stop listening to the news and focus in on your family and do all the things, all the good stuff medical professionals are telling us to do at the moment. And you'll end up like this guy. Just as this is not an aside, I just want to demonstrate what's possible. I made some statements, and one of the statements I've made in this presentation, that I've done all this before, and I've gone and broken down this in detail with people that are in the room, and I even made a little mistake in 19 but starting from the low, there was a 22% return that I pulled out of the market from the 19 low. The low started on the 26th to the 28th of December 18. Just 6 months forward from that position was a 22% return. I think that's small compared to what's about to happen. That was a V-shaped recovery, and I think you're going to see one coming up very soon. So there's the corrective phase in this market, that is the capitulation. I've talked about it. This is the third opportunity, the bottom of the market, where for all the reasons I've given, will be well supported and the market will move back into a strong bull market phase in the very, very near future. When I say the near future, when it occurs, I didn't mean in the near future. Just like to ask you a question. In the near future, using my guidance, if I could replicate similar performance generated from the 2019 low for your account, what would this be to you? What would this be worth to you? If it's worth nothing, I'm not going to be speaking to you because you don't care about your financial security. You're just sitting in because you're bored and you're sitting at home. That's absolutely fine. But for my active clients, I have promised to define the end of this corrective phase in real time, hopefully presenting a unique opportunity to produce superior returns by the end of 2020. How can I help you? Well, next week I have set aside some time to speak to you personally. In fact, I think I've got some time on Friday. I will assist you to make a series of decisions that are based on objective measurement, not guesswork, that has the potential to deliver the best returns that you have ever received. Just give me one moment. But there's only a certain type of person I like to talk to, and I'm really, along with a lot of people, really busy trying to service and look after a lot of people. So if you want to talk to me, I would like to think you're an individual who are absolutely 100% committed to the success and hitting investment income goals, no matter what, by following the guidance I offer. I'm hoping you're strong-willed, goal-orientated individuals with confidence and good organisation, value knowledge and understand its transformative value. And I'm not being impolite. If it doesn't describe you, it's okay not to talk to me, because on the call, what I want to do is closely examine your investment goals, not just have a general discussion, and I want to help you get absolute clarity on how to reach them fast. If I work with you, we'll walk through a strategy that is designed to position your portfolio to take maximum advantage of what may be a once-in-a-lifetime opportunity, investing in equities, bonds, precious metals in both US and Australian markets. If you want to talk to me, there is a link on screen which you probably can take a screen capture of, or what I can do, and what I should have done already, is take a capture of that link, and I'm going to stick it in the question panel. That is your question panel. Watch this. It'll come up on your screen. Just going to paste it in there, send it to everybody. It's now in the screen. I can also stick it in the chat panel. If you want to have a chat to me, I can only do it in an organised fashion. Use this link, fill out the form, and it just organises our time together. It sends us reminders. It automatically sets up a GoToMeeting link, and it all happens, and I turn up, and you get reminders to make sure you turn up at the right time. If you want to have a quick chat to me, you can send me an email, but if you want to have a proper discussion with me, via GoToMeeting, please use that link. So there are two types of people. There are people that they're sitting under their blankie on the couch watching Netflix, probably watching Contagion, scaring themselves, remember that one? Matt Damon and that girl from Titanic, scaring themselves senseless, worried about the world when all they got to do is sit there and do nothing. So some people will do nothing in terms of financial management. They won't do any strategy because it requires zero risk. They have no faith and they miss out on all the opportunities. If that's the way you operate, that's fine. I can't control that. But there is a second option, and that is to start to look at the world from the positive, reframe your thinking, see things that can be significant once-in-a-lifetime opportunities, and invest the time into seeing what's possible for your investment future and be willing to implement strategies that create a future life that you want. I'd just like to thank people for your time. I've given you a really big chunk of information, which is valuable. That's valuable information, and it can fly in the face of the negativity that's being pumped out to you by the media. But I can assure you that my fund manager connections absolutely agree with every word I've just said, and there is a disconnect between the retail investment public and the professional investment world, hence for this presentation. That's it for this evening. I'd just like to thank once again everyone for your time, and I look forward to talking to you all in the not too distant future. Thank you.